Hello, everyone. I am your accounts teacher Akanksha. Welcome to our lesson on partnership accounts. Today, we'll be looking at a specific adjustment called investments taken over by partners partly. This is part 3 of our series on partnership adjustments, so if you haven't seen the previous lessons, you might want to go playlist and watch those as well. Let's imagine we have two partners, X and Y, who are currently sharing profits equally. The firm has some investments in balance sheet, worth 80,000 rupees in total. Now, a new partner, Z, wants to join the partnership and is going to get a 1/4 share of the profits. When Z joins, X and Y decide they want to take over half of the existing investments at their current book value. This means they will withdraw those investments, and such investments will no longer be part of the firm. The remaining investments will stay in the firm, but those will be revalued. To account for this, we need to make the adjustment in two parts. Part 1, X and Y take over half of the investments, which amounts to 40,000 rupees at the book value. This is like them withdrawing from the business, and hence this is part of drawings. There's no profit or loss to calculate in this part because they're taking the investments at the book value. Part 2, the remaining investments, also worth 40,000 rupees, are revalued. In our example, they're now worth 50,000 rupees as per question, so there's a revaluation gain of 10,000 rupees. Let's look at the journal entry for part 1 of the adjustment, where X and Y take over 40,000 rupees of investments. We'll debit X's capital account and Y's capital account with 20,000 rupees each because their capital in the firm is decreasing due to drawings. They are taking assets out of the business, so their capital goes down. We'll credit the investments account with 40,000 rupees because the assets of the firm are decreasing. Now, let's move on to the journal entry for part 2, which deals with the revaluation of the remaining investments. We'll debit the investments account with 10,000 rupees. This is because the value of the investments has increased, an increase in assets is debited. We'll credit the revaluation account with 10,000 rupees to show the profit made from the revaluation. Let's now move to revaluation account. In the revaluation account, there's no entry for the first part of the adjustment because X and Y took the investments at the book value, so there was no profit or loss. However, for the second part, we have a credit entry of 10,000 rupees. This represents the revaluation profit from the increase in the value of the remaining investments. Now let's see what happened in the capital accounts of X and Y. Each partner's account was debited with 20,000 rupees, which is their share of the investments they took from the firm. Because they share profits equally, they each took half of the 40,000 rupees, which is 20,000 rupees each. There is no entry on the credit side of capital account. Finally, let's see how this adjustment affects the balance sheet. The investments will now be shown at their new revalued amount of 50,000 rupees. We arrive at this figure by starting with the original value, 80,000 rupees, subtracting the value of the investments X and Y took, 40,000 rupees, and then adding the revaluation gain, 10,000 rupees. There is no impact on the liability side. It's important to remember that this adjustment process applies to any asset the firm owns, not just investments. It could be machinery, furniture, vehicles, computers, or anything else. The steps are the same. Also note that the same steps apply whether the question is for change in the profit-sharing ratio, admission, a partner retires, or in case of death of a partner. And that's it for investments taken over by partners partly. We've covered the scenario, the two-part adjustment, the journal entries, and the impact on different accounts. We hope this lesson was helpful. See you in our next video.